momentum yesterday as well, and $70 is just upon the hill. As we had forecast on this platform a week or so ago, that developments in Texas may indeed be the trigger to get to 70, and it might look like that's the case after the EIA reported yesterday that still 1 million barrels of US oil production knocked out. Let's start the morning with Matt Stanley, Director of Star Fuels. Matt, prices again upward moving.
Yeah, morning. Yeah, look, Thursday of IP week, so this is the clearest my head has ever been in 21 years, I think. It's extraordinary. Yeah, I mean...
This healthy living has to stop.
It's got to... I mean, this new normal is not good for me.
I can't keep doing it.
67.50 we hit this morning. Yeah, it's relentless. It's relentless. And I think, just to start with an item on your digest, I think, Saudi borrowing at negative interest rates is really that's a global thing at the moment. Money is cheap. And this is money flow that we're seeing in the commodity market. There was a build on crude last night. It was much in line with what API was saying. US crude production is coming back slower than anticipated, but so are refineries. So I think the data is a little skewed. The data is taken EIA Friday to Friday. So I think next week we may see something more of a realistic outlook on what Gulf Coast production and refineries look like. Yeah, look, so you broke the news first, Sean. Like you said, 70 is the new 50, mate. I mean, what can you do?
Dr. Carole Nakhle sitting in the Black Forest of Germany. The Federal Reserve has been busy this week convincing the world that inflation doesn't matter anymore, interest rates are extinct, and they're not even going to look at inflation or interest rates for at least 3 years. This is a run that could last a while.
Indeed. Good morning, Sean. Good morning, everyone. What he actually keeps on reminding people is that their target, which is also not only about inflation, but also full employment, and we're not there yet. And it's not only him. There's also some executives on Wall Street. They're also coming up in solidarity, calling on the government, Joe Biden, to really go ahead with the stimulus because they are not scared of inflation hitting. So in that respect, that would be another boost that supported the increase in prices that we saw yesterday, we might well see even today. But still, Sean, I mean, if I look at the fundamentals only, you mentioned the disruptions of supply in the US. Of course, if you focus only on the scale of the disruptions, they do qualify as being major disruptions. But if I compare them with similar disruptions in the past, in the history of the oil industry, you can see that such disruptions do not always translate into sustainably higher prices if the market has significant inventories built up and a high spare OPEC capacity, which we have today. So, and the demand, yes, is recovering, but it's not like a stellar recovery, this kind of roaring back recovery that people have been talking about. So this tells me there is also an additional factor which is contributing to this rally. And this is, in my opinion, is the fear of inflation. So even if Powell says it's not going to happen, you cannot dismiss that people are concerned increasingly about it. And as such, they are putting their money in assets where they feel that they can protect it, such as precious metals, and all because it's quite easily traded. So it's much more to the story than simply saying inflation is not going to happen and the fundamentals are very robust and therefore we're going to live happily ever after. There are more layers to the story, more unconventional factors that are affecting oil markets today.
Well, the more the Fed chairman has to say inflation doesn't matter, you would imagine inflation probably matters. Ahmed Mehdi, welcome back to the table, research associate at the Oxford Institute for Energy Studies. With OPEC meeting next week, Ahmed, how do they navigate this particular moment in time where we have perhaps the distortion of the US ice storm in Texas complicating how they should read the tea leaves? What do you think is the mood within OPEC, within Iraq, as you know well, at this point going into the next decision?
Good morning, Sean. Yes, absolutely. I think actually it's quite a rare moment where OPEC policymaking and flexibility is actually there. I mean, I think it's very rare to have a moment where certainly the Saudis seem to be quite in control, I think, with regard to the question marks on the 1 million cut that they imposed earlier this year, and whether or not that will come back. I think it's likely it will, but the question is going to be whether that 1 million will come back immediately. I'm not so certain. And likewise, the phase 3 of the OPEC cuts as well. How that's going to come back. With 500,000 being discussed. I think that what is interesting is that both Russia and Saudi Arabia have slightly different views on the market. Saudi has continued, even in the context of Brent, above $65, have continued to talk about demand uncertainty. Likewise, we're still talking about 7 to 8 million barrels in OPEC spare capacity. So there are some factors which, you've talked about $70 oil, but also at the same time, once that US production comes back online, you've also got OPEC spare capacity, and more importantly, you've also got the issue of they don't need to rush. They're in a position of in a pretty good position to make a decision where there's a lot of options on the table for the March the 4th meeting.
Matt, I also included in the digest this morning, although I was a little bit reluctant to join any hyperbolic language, but $100 oil headline is always one that gets my attention. And I included it because I don't think it's that unrealistic, given all of the dimensions where this market is going, where the Fed is going to pump it up for the next, as they said yesterday, at least another 3 years, given everything else that's going on. Oil is cheap at these prices. Why would OPEC be concerned at all? They should just pump as much as they can.
I think you're absolutely right to put it into the digest today. It's the dreaded $100 a barrel story is always your cue to start selling the market, because you know that it's going to come down to 50 pretty soon. But it's, in terms of momentum, we've seen a flat price rally on Brent since the beginning of November of 85%. You look at the curve and you extrapolate the chart, then we go to $200 by the end of June. So it's an incredible rally that we've seen. It comes down to something that I consistently mention on the show, is demand destruction. The higher flat price gets, let's bear in mind that we're still in recession. How many people are feeling the financial pinch owing to furloughed workers, whatever it might be? Are they going to get in their car and fill it up if gasoline could get to $3 a gallon in the US, So
I suppose Bitcoin can go to 50,000 without hurting anybody, but oil going to 100 has some very real ramifications. So perhaps it cannot participate in that same euphoric rally we're seeing in other asset classes.
If Elon Musk was in the oil business, then we'd probably be at 150 by now. Look, it's the ability, this Twitter trade and what it can do. People who are jumping on the bandwagon, these day traders, these penny stock traders, whatever they are, they follow momentum, they follow funds, they follow cash flow. And oil is in that asset class at the moment. It always has been. But it's this detachment, like Carole said, Ahmed said, it's the detachment from the fundamentals that are really creating this cavern of understanding that we're seeing at the moment. And it's a concern. It will be something that OPEC next week will have to address, because if we're in a fragile state on the rally, then we're in a fragile state to go the other way as well. So it'll be interesting to see what happens.
Carole, your thoughts on that, the idea that OPEC does or does not need to be concerned about this level of price in their judgment about navigating the next quarter?
High oil prices may on the surface appear as a blessing for oil producers, given the dependence of their economy on oil revenues. And we see that some countries such as Iraq, Nigeria, Angola, and even Venezuela, they've been struggling a lot economically speaking. On the verge of failing economically speaking. So definitely high oil prices would be a blessing for them. But that is just one side of the argument. In my opinion, high oil prices just spell trouble for an organization organization, the group producers organizations such as OPEC Plus. And why I'm saying this, yes, Matt alluded to the demand destruction, maybe, but there is also, in my opinion, two other things that we should keep in mind, taking different time frames, of course, into consideration. First, you have the additional supplies, shale. I know, people on this platform tend to be quite dismissive of the outlook of shale, maybe under current market conditions, but don't forget, let me take you back to the 1990s, mid-1990s. Major forecasting agencies simply dismissed the Gulf of Mexico and they called it Dead Sea for exploration. A few years later, it boomed back and production overtook whatever they were producing then. So we're talking about the US there. We are talking about still a relatively new industry that can still react quite quickly to these kind of, if they are sustainable higher prices. And then in the longer term, there is the issue of energy transition. What do you need to accelerate the energy transition? You need to have the right price signal. So when you are going to make prices higher for fossil fuels, and here we're talking about oil, then you simply make renewable energy, alternative source of energy more attractive. So I don't think you see whether in the short term or the longer term, higher oil prices are necessarily good for OPEC. And of course, there is the negative impact on developing economies, which are coming out of the crisis, and they don't need these kind of prices to support their economic recovery.
Ahmed, we saw earlier this week, I think time is distorted now, but ultimately recently Iraq moved away from its decision to forward sell its crude oil. What do you think of that decision? Should we take note of it? Is it important? What's your views?
Yeah, absolutely. So just to inform your listeners, so just prior to annual allocations to term customers in November of last year, Iraq put forward a proposal towards a 5-year tender, and one of those 5 years would be to, as you rightly say, put forward prepayment to sell 48 million barrels a month, which roughly is about 130,000 barrels a day. And in the end, the beauty of the deal was effectively that Iraq would get around about $2 billion, and the buyer would get that 4 million barrels per month of destination-free crude. And Genoa then put forward all the paperwork, and it was a rushed process. The buyer had to put forward get the export financing and what have you all together, and just before the deadline. So it was a very rushed process. Then there was a lot of media stories about, oh well, actually they decided against it because of rising oil prices, but actually it's not accurate. So what actually happened is that the Ministry of Finance did not give any guarantee, a sovereign guarantee, that in case of any disruption or force majeure to those deliveries, that the Ministry of Finance would not intervene to basically issue that sovereign guarantee, and that was not acceptable to Genoa. The problem is that, okay, well, flat prices, as Matt has said, have obviously increased, so there is less financial pressure. But as Carole also mentioned, that the market is cyclical, and fundamentally, we're still talking about the fact that the next time that there's a situation where prices are lower, and then SOMO's credibility has been damaged, fundamentally. So it's not a good signal. At the same time, in the north of Iraq, they obviously continue to execute prepayment deals. They have if you look at the volumes of Kirkuk or other Kurdish blends, they are under prepayment deals and mostly go to Rosneft, Trafigura, and Vitol. So
I suppose what it tells you in a way, as Carole pointed out, that there are a number of OPEC plus countries that are in severe fiscal challenge, and they have to come up with these creative ways in which to drive revenue or not, and that's probably going to keep going. Matt, can I bring you back in to talk a little bit about inventories? We saw a strange thing this week. In essence, U.S. inventories built crude 1 million, I think, or give or take, but distillates had a big enough draw, over 4 million barrels. What's your read on that?
It's a good question. Refinery rates are obviously a lot lower. There's obviously some demand for heating. That's obviously what the draw was. The grand scheme of things, we're entering maintenance season now, so a lot of refineries will be going offline anyway. Stocks globally are drawing. Fujairah figures are out. They're looking pretty good. Singapore last week was, I think, at a 14-month low on fuel oil stocks. But everything needs to be replaced. There's currently an armada of ships on their way to Singapore for the 0.5 fuel oil. So you've got to look at refining margins. They're still suppressed. They're still low. Gas oil is specifically in the EU. It's unseasonably warm there. As Mike said yesterday in your your first session, he was scraping the ice off his car going to Grosvenor House a couple of years ago. And now, you're just about wearing a suit jacket. So it's Greta Thunberg's certainly right about global warming. And I think that's suppressing refining margins at the moment as well. But
if you just on that point, the temperature swing in Texas last week from minus 14 degrees Celsius, I think, to plus 15 or something in the space of a few days.
Yeah, I spoke to someone in Houston yesterday who said it was 24 and he was going to go and play golf. He said the week before he was getting his toboggan ready. It's like, what's going on? But the fuel oil guys will love me saying this. The strength of the last 12 months undeniably has been fuel oil. 0.5 fuel oil has kept refining margins at least afloat, just about. So they're still high. You've got a difference in a gasoline refining margin, which in Europe is about $6. On fuel oil, it's $14. So there's a lot of reliance on that part of the barrel staying strong, and it does look healthy. Bunker demand is good, but it needs to sustain that in order for stocks to be drawn continually.
Carole, I wanted to get your views also on the borrowing rates that Saudi was getting, that was reported yesterday, negative, and just the general fiscal health of the Middle East and the Gulf states are going to drive them more and more to the debt markets, as they have been accelerating in that direction in recent times. And given the current fiscal health, that will continue. What do you think this means for the outlook of the Gulf states' macroeconomic outlook?
The macroeconomic outlook has not changed drastically compared to what I've been, following for years, which is still there is a need for serious efforts to diversify the economies away from oil. Otherwise, we're going to continue to see their exposure to this kind of cyclicality that we see in oil markets. And this is not good for any economy, let alone for the Gulf economies. So this is, if you want, the bigger picture. But of course, today, we have to be careful. I cannot put all these countries in the Middle East within the same basket, because you do have some which are in a much stronger financial position than others, such as Kuwait and the UAE, with their massively accumulated financial resources over the years in their sovereign wealth fund. And you have on the other side of the spectrum the really weak economies of the Middle East, such as, for example, Iraq, and I would even put Oman closer to that area, and Saudi Arabia is somewhere in the middle. So it's quite a mixed bag that we have. But today we have these low interest rates, so it's a very good time to borrow. However, we already have hugely indebted governments all around the world. I'm not too concerned about the Saudis borrowing money. I do recall when the crisis in 2014 hit, people were concerned about the Saudis draining down their financial reserves, and they would have massive economic structural problems. And I always argue the Saudis are in a much better position than their neighboring countries, such as, for example, Oman, because they can capitalize on their massive and low-cost oil reserves. And that's what they are doing today. And they have the capability to pay back their debt. But that doesn't mean that everybody can replicate their strategy, because again, structurally, the economy is not really strong. And mind you, they entered this crisis, this COVID-19 crisis, with negative growth rates outlook, while everybody else had positive growth rate for, they entered in a stronger position. So there's a lot of work to do. And this is where I want to voice my concerns. Ahmed already talked about Iraq, but the problem when you have this kind of recovery in higher prices, to add to the point I said earlier that it spells trouble, is that it can divert attention away from the need to pursue economic reforms. So yes, Iraq announced some economic reforms, and other countries in the region as well. But experience tells us that the second prices start to recover, they can't drive their attention away from these reforms, either delay them or simply forget about them. And this means we enter another round of problems when prices go down again.
Let's get the room's view on this price issue. Should OPEC be guided by, if we bring up the survey question, should OPEC Plus be concerned about oil prices climbing too high, too fast? I mean, we have negative interest rates. We've got incredibly weak dollar. Maybe $70 oil today is $50 oil yesterday. I mean, the price of all assets are in elevated positions. So the question is, should OPEC Plus be concerned about oil prices climbing too high, too fast? Obviously ahead of their meeting next week. So that is my question to the room. Ahmed, we do have this outstanding issue with Saudi Arabia doing its unilateral cut. Your views on whether that will be sustained, or should we expect that to come back? And what are your thoughts also on Iran's return? Do you think those talks can accelerate quicker than maybe we had previously expected?
So in the context of when the 1 million cut was imposed, there were question marks around, how basically is Saudi assuming its old role again? And I think actually, we wrote some issues about this at
its old role, like as the swing producer.
Exactly. And actually, there was a very good research note put out by the Institute a few weeks ago. Well, actually saying, if you recall last year, in the summer of last year, Saudi UAE also imposed a similar temporary unilateral cut, and in fact, it's the ability to respond and actually have that flexibility later because of the demand uncertainty, which is important as a point. And actually, there was, Saudi was slightly vindicated, with some of the if you saw the demand in January and then afterwards. So really now we're in a position where, okay, yes, there's that 1 million, time bomb, if you like, that they're sitting on, and how will that be released? But they have the flexibility to do so.
I mean, it seemed like it was very impactful when it was announced in January, which is only a month or so ago.
Yeah.
Now it feels less relevant.
I think that the another point was that a lot of the Asian refining customers that Aramco have, they were also ongoing maintenance at the time.
Right.
You also now have, as Matt talked about, the refining margins. You also have actually the fundamentals also in Asia certainly improving. But also
Saudi itself was doing field maintenance.
Exactly. And then you also have the fact that, with regard to, the Russians wanted a small, increase. Okay, but the differences are so significant. So that, I don't think that that's necessarily, I think if anything, it shows that the flexibility to respond has been actually quite impressive. But in saying that, as Carole mentioned, there is an issue of what's going to be the sweet range. And I think that with regard to perhaps this meeting coming up, there will be, I think, debate between, significant debate over the phase 3, how that's actually going to be timetabled. On Iran, I think I read something by your team this week, a very interesting note about Iran, and correctly suggesting that there has been an increase from Q4 of last year to January. I think with exports, certainly those that are tracked by a range of agencies suggesting about 670, even up to 700,000 barrels a day of exports. And obviously, we're seeing that through all kinds of places, whether that's through bonded storage or through Indonesia, Malaysia. But in saying that, I think that what's important with Iran is the difference of opinion is quite big, actually, in terms of the range of the range of uncertainty on how much Iranian volume may return this year. We've seen, for example, some agencies like Platts suggesting, are more bullish on the return. Others, such as FGE, for example, suggesting more towards, 2022 is perhaps a better way of looking at things. I
suppose you've got two things to consider. One is whether it's more oil with the relief of sanctions, or more oil in violation of sanctions. Perhaps that's the question that's hard to tell.
I think there's a ceiling on the actual illicit crude, if you'd like to call it that.
But I think the question becomes, will it be policed, or will the policing ease off? It's easier to ease off the policing than it is to remove the sanctions in the Congress, at least.
But just one thing I would say is that, just last point is that obviously you probably mentioned this before, but we have to, the timetable is obviously going to be determined by, the elections coming up in Iran, but also with regards to US policy priorities.
And that's the thing, how you want to position that, because whoever wins that election could be in prime position for who becomes the next supreme leader of Iran. Matt, we're on Thursday, Middle East weekend. What should we be keeping an eye out for over the coming days while we're off at the beach swanning, drinking our pina coladas while the people in Europe are freezing?
Yeah, quite. There's a couple of things. I mean, I suppose it's just watching where flat price is going, because it's volumes are lower than they are, and that inherently means the volatility is up. And yesterday I think we went down to a low of 64.80 and we went up to a high of 67.31. So $250 ranges in specific times of the day where they're coming in. As soon as Wall Street wake up and have a cafe au lait, then bosh, market goes straight up by $1. So it's about keeping your eye on the market at specific times. The one thing that concerned me yesterday, which wasn't really discussed, was the latest IATA report regarding travel, which was a lot more pessimistic than they initially forecast. They gave two scenarios regarding jet fuel demand. And let's bear in mind that the return of demand, a lot of it hinges on jet fuel and what happens there come Q3. That is really important for the distillate cracks and for product demand in general. And they said their most optimistic scenario for 2021 was that 38% of demand basis 2019 levels will return. That is not great. So I'm keeping my eye on that really closely. And the structure when it comes to what's called the regrade, the difference between the price of jet fuel and gas oil, that's still low. That's still low throughout the rest of the year. They're the ones that I'm really looking at.
Okay, let's get the survey result before giving Carole the last word today. Yes, by a big margin. Should OPEC Plus be concerned about oil prices climbing too high too fast? An overwhelming 76% says yes, they should. Carole, your thoughts?
Yeah, not surprising, but I tell you, I've been smiling throughout because I remember I've been doing these kind of webinars with you, Sean, for several months. And a few months ago, both COVID and Trump perhaps dominated the discussion. And today we haven't mentioned COVID, I think, not even once. And I think this kind of reflects also the overall sentiment. But the virus is still out there. It's still growing and flourishing. I mean, India had major outbreaks with the new variant. So it just,
the US has just crossed 500,000 deaths. And at the best case scenario, expect to get to 600, perhaps even 700,000.
Exactly. So it's not, so this fundamental problem that messed up our lives upside down has not evaporated despite the market signal. I mean, I saw yesterday the reaction to the announcement of the government of easing gradually the lockdown, how the booking for holidays increased. But you never know. You don't want to be in a country where you just want to spend 2 weeks and then suddenly you end up being locked in for several months because of the eruption of a new variant. So we haven't heard the end of the story, but the evidence from our webinar, from our podcast shows that people are not really as concerned as before about COVID. There is a COVID fatigue, but it doesn't mean that COVID has disappeared.
Well, I suppose the question is, how disruptive is it? And we're still on this sort of paradigm for the two halves of the year, a year of two halves, where the sort of outlook for the second half. And given some indicators, the UK and Israel, where the spread of COVID is curtailed by the Pfizer in particular, I think they've identified. But nonetheless, you're absolutely right. This is a pandemic that remains a major challenge. A very small percentage of the world's population will be vaccinated even this year. So the variants and the other challenges are clearly there. It's always been a market recovery of the two parts of the K, and that looks like it will continue. But for now, we must wrap up the day, wrap up the week. And thank you, Carole, and thank you, Ahmed, for particularly. Ahmed wins the prize for waking up the earliest, because London is 4 hours behind, whereas Germany is only 3. But that's the way it is. Thank you both, though, for being stalwarts in that regard. And Matt, thank you for your insights and contribution today. All the best. Have a great weekend, and we'll catch you all on Sunday for our regular, our Christoph Rule, and also Amrita Sen will be joining us on Sunday morning. So all the best.
Thank you. Bye-bye.